Good day, I'm Nova Lui, Head of Investor Advisory at RHB Bank. Welcome to our Money Chat series. In today's episode, we will be doing an educational session on the different types of structured investment and how investors can use them to express their market view, whether you are bullish, neutral, or bearish. Over the past few years, structured investment has gained real traction in Malaysia's investment landscape. They offer an alternative path beyond traditional unit trusts and direct equities or bonds. At their core, structured investment link its return to an underlying, often a single share, a basket of equities, an ETF, or even interest rate, while shaping outcome to match a market view. The appeal for this product is clarity, predefined condition for potential coupon or early redemption. As market matures, many experienced investors are looking beyond traditional plain vanilla product and explore more customized structured solutions. These structures allow investors to fine-tune their risk-return profile, payout frequency, and core features to better suit their views. Different investors want different type of exposure. Some prioritize steady coupon income in a sideways market, while others focus on capital protection or the opportunity for early redemption. Structured investment can offer better control over how and when income is paid and how capital is returned, echoing the old saying, a bird in hand is better than two birds in the bushes. If you are new to structured investment, it's important to start with the basics. Take time to understand a few key elements. What are the underlying assets? How long is the product tenure? How the coupon or income is triggered, and under what scenario your capital could be at risk if the market moves against you. Once you are clear on these building blocks, it becomes much easier to decide whether a particular structure fits your investment goal, risk tolerance, and time horizon. To help you get there, explore our previous episode. Click on the link below in the description section where we have articles and video that walk through foundation concept step by step so that you can understand structured investment better and make an informed investment decision. Thanks for staying with me. If you are still listening, you probably already have some idea how auto-callable equity-linked investment works. So let's zoom in on auto-callable step-down. Here's a simple overview chart of common structured investments. In today's Money Chat, I will focus to discuss three key variants: the auto-callable step-down, auto-callable bullet, and callable range accrual, highlighting each payout features and condition for callable features triggered and when they may be most suitable. In a plain vanilla auto-callable equity-linked investment, there is a knockout feature. On each observation date, if the underlying share is at or above a preset knockout level, the product auto-calls and mature early. That knockout level typically stays same through the life of the product. If the underlying drift lower instead, it becomes harder to hit that fixed knockout level. Hence, the chance of early redemption falls. In a step-down structure, the knockout level gradually decreases over time, often at this small step at each observation date. Because that knockout barrier moves lower, the investment can still auto-call, even if the underlying is trading below its initial level, as long as it's above the reduced knockout level on the observation date. When a knockout is triggered, investors typically receive back their full initial principal together with the coupon accrued up to the call date. This type of structure is generally suitable for investors who are constructive in the short term of the underlying stocks, but see a risk of moderation or softness over the medium term. In simple terms, they are prepared to receive somewhat lower regular coupon in exchange for a step-down features, which can increase the chance of getting back their principal even if the share price experiences mild weakness later on. Early termination or auto call is usually a good thing. It means you'll get back your capital sooner and you earn some income. But there is a trade-off. If the structure is called back very early, you give up the chance to collect coupon for the rest of the product tenure. Imagine this: if you found an underlying that you really like and enter at a very attractive price level, but the structure gets called back on the first month and you only receive a small prorated coupon, and now you're back in cash, looking for a new idea and having to reinvest again. That's where an auto-callable with a bullet coupon instead comes in. Instead of paying a coupon gradually up to the call date, this type of structure pays a lump sum coupon upfront at the beginning of the observation. If the structure auto-call early, you have already locked in that full coupon in one shot, rather than just a partial payout. There is another subtle benefit that is not always obvious at first glance. Because the coupon is paid out upfront, you can reinvest that payout where your effective return can be slightly higher. And if the structure is called back early, your overall return can look better than the headline coupon suggests. From a time value money perspective, getting both your capital and income earlier gives you time to reinvest and compound your return in the long run. If the bullet structure sounds very appealing, it's worth asking, what's the trade-off? Because you have been receiving the coupon upfront, the headline coupon rate is usually lower than the similar structure that pays coupon on a prorated basis over time. In simple terms, you are trading a slightly lower rate for the benefit of getting your coupon in one shot at the start. This style of structure is generally suited for investors who have a strong short-term positive view on the underlying, prefer some downside cushion through a knock-in buffer, and already have a clear target return in mind via the bullet coupon. Bottom line, investors who choose bullet design usually want an early knockout. You have locked in your income upfront, and your goal is to get back your principal quickly so that you can redeploy it into the next opportunity. Now that we have talked about two non-principal protected structures, let's wrap up with something different: the Callable Range Accrual (CRA), which is a capital protected structure at maturity. This type of product tends to stand out in the interest rate cut environment, where fixed deposit rates start to drift lower. Some investors look for alternatives that is still protect their principal but offer a potential for a slightly higher coupon, provided the reference underlying stay within a predefined range. CRA is usually designed as a long-term investment. Coupons are paid on the quarterly basis as long as the reference rate stays within the agreed range during an observation period. If the reference moves out of the range, there is simply no coupon for the period, but the principal remains protected at maturity. Because it's callable, the issuer also have the option to redeem the structure early under certain conditions, returning your capital and any coupon accrued up to the call date. In a Callable Range Accrual, the underlying reference is usually an interest rate benchmark, such as either the 3 months or the 6-month Callable. The coupon for each quarter is calculated based on how many days that reference rate stay within the predefined range. So, if during the particular quarter, the reference is within the range for roughly half of the day, investor will receive only about half of the headline quarterly coupon for the period instead of a full amount. On top of that, CIA structure usually have a callable feature. At each observation date, the issuer has the option to redeem the product early. If that happens, investors receive back their full principal along with any coupon accrued up to the call date. This type of income-focused product is generally suitable for investors who wants capital protection with the potential for payout higher than a typical fixed deposit, especially if they believe the reference rate is likely to stay within the agreed range over most of the product life. In that case, a CIA can be a useful way to express that view while keeping principal protected at the maturity. What happens if the structure is called back earlier? If the issuer exercises the call option, you receive back your principal together with any coupon due up to the point. In a low interest rate environment, it is often the case that higher risk assets can perform better. So, early redemption may be a good opportunity to review your overall portfolio and consider whether taking on a bit more risk within your risk profile could enhance long-term return. Thank you for spending your time with me today. I know we have covered quite a lot, but I hope this session has helped you better understand how different structured investment works and how they might fit into your broader investment strategy. Shall you need more clarification? Feel free to contact our Premier Relationship Manager for more information. See you again in our next Money Chat series.